Foreclosures and court-ordered sales, a practical guide for realtors. This is from BCREA, and it's a PDP course. Now, this is from 2016, copyright, BCREA. Learner objectives. Upon completion of this course, the learner should be able to discuss mortgages and mortgages in default, describe the steps in foreclosure proceedings, explain the basics of court-ordered sales, describe how to present an offer to the court, and appreciate the risks involved in selling foreclosure properties. Section 1. Mortgages in review. What is a mortgage? In order to fully understand the foreclosure process, one must fully understand mortgages. To someone who borrows money to purchase a home, a mortgage is often perceived as a loan, most typically paid back by a series of fixed payments combining principal and interest over a period of time called an amortization period. From a lender's point of view, a mortgage is a charge on the estate of the borrower to secure the repayment of a loan. This security for the loan is both a personal guarantee to repay the debt and a pledge of the property as security for that loan. If payments are not made, the lender has the ability to repossess the property by way of foreclosure proceedings. In a legal sense, however, a mortgage is only evidence of a loan. On its own, it is an interest in land created by a contract with two significant parts. There is a promise to satisfy an obligation and a covenant entered into by two or more people. Two basic elements must be present in order for a mortgage to exist: a debt and a pledge of property to secure the debt. So, in other words, a mortgage is a debt secured by an interest in land. The mortgage document is evidence of the debt, and that is what is registered in the Land Title Office. This transfer of an interest in land as security is the most common form of financing used in modern real estate practice. Definition of a mortgage. It is important to distinguish between the financial and legal aspects of a mortgage. Legally, a mortgage is not a loan. It is an interest in land created by a contract as security for a loan made by a lender, the mortgagee, to the borrower, the mortgagor. Although almost all mortgage agreements contain a promise to repay a debt, a mortgage is not a debt itself. It is evidence of a debt. More importantly, it is a transfer of a legal or equitable interest in land, on the condition that the interest will be returned when the terms of the mortgage contract are performed. This usually means upon repayment of the debt. A mortgage agreement usually transfers title of the borrower's land to the lender. However, the transfer has a condition attached. If the borrower repays the loan or performs some other obligation under the contract, the transfer becomes void, or the lender must transfer the interest back to the borrower. Essentials of a mortgage. A mortgage is a conveyance of land as security for the payment of a debt or the discharge of some obligation for which it is given, and the security is redeemable on the payment or discharge of such debt or obligation, any provision to the contrary notwithstanding. Although almost all mortgage agreements contain a promise to repay a debt, a mortgage is not a debt itself. It is evidence of a debt. More importantly, it is a transfer of a legal or equitable interest in land on the condition that the interest will be returned when the terms of the mortgage contract are performed. This usually means upon repayment of the debt. A mortgage agreement usually transfers title of the borrower's land to the lender. However, the transfer has a condition attached. If the borrower repays the loan or performs some other obligation under the contract, the transfer becomes void, or the lender must transfer the interest back to the borrower. In almost all cases, the obligation in a modern mortgage is the repayment of borrowed money. As a result, the relationship between parties to the mortgage is one of debtor and creditor. As you will see in Figure 1, the borrower is called the mortgagor and the lender is called the mortgagee. The mortgagor borrower grants the mortgage and receives the loan. The mortgagee lender receives the mortgage and grants the loan. Figure 1, parties to the mortgage. The lender, called a mortgagee, provides loan to borrower, receives mortgage as security for loan. Borrower, called a mortgagor, obtains loan from lender, gives mortgage as security for a loan. Another way of looking at a mortgage is as follows. Mort means a great quantity or number. Gage means pledge. So a mortgage means a big pledge. And if a pledge is a promise, then what exactly is in the big promise or the fine print in the body of a mortgage? Reading the fine print. Often people think that if they stop making their house payments, the bank will simply take back their home and they are off the hook, but they are wrong. Their obligations do not stop there, as the creditor lender has contractual remedies available. An action to receive damages by way of a judgment is likely. This can happen even well after the home has been sold. These actions can even be binding upon the borrower's heirs. Under the Mortgage Brokers Act, an order of foreclosure is always subject to being reopened if equity demands it, for once a mortgage, always a mortgage. A mortgage is a commitment agreement. The document itself contains fine print or covenants, promises outlining the obligation to pay the amounts owing, including other things such as legal costs, taxes, insurance, strata fees, assignments of rents, and costs of any action in agreement to repay in accordance with specified conditions. The document makes the borrowers personally liable for their obligations to pay, and they certainly cannot simply abandon the property to avoid payment of the debt. The actual legal mortgage document gives the parties to the contract rights and obligations. The document and series of covenants or promises agreed to by the borrowers and the lender have conditions that will differ and vary from document to document, and the charge which is registered in the Land Title Office is security for those covenants or promises of an interest in the real property. The Interest Act regulates the amount of interest that can be charged on overdue amounts by ruling that a mortgage cannot demand an amount beyond the rate of interest that was payable before the mortgage was in default, and cannot demand a fine or penalty more than the rate of interest payable on the principal money that is not in arrears. Lenders have found a way around this, and most recently an interesting change has come about on some mortgage documents. Some lenders are starting to add a clause to their mortgage agreements as follows. Sample clause number 1 from Royal Bank of Canada. In the event of default, the outstanding principal shall bear interest at the prime rate of interest plus 2% per annum, calculated and payable monthly on the first day of each and every month, both before and after maturity or default, until full repayment of the said principal sum. Sample clause number 2 from Pacific Coast Savings Credit Union. After the demand date, the interest rate will be on any particular day the greater of the above rate or the declared prime rate of interest of the lender plus 5% per annum, calculated monthly. If the lender will not declare a prime rate of interest, the prime rate of interest will be the latest declared prime rate of the lender. Interest is payable both before and after maturity, default, and judgment. This actually means that when a lender grants a mortgage to a borrower and the portfolio comes up for renewal, the lender will send a renewal agreement approximately 1 month before expiration. If the borrower does not sign the papers and send them back, the mortgage reverts back to its original term and interest rate. This could be a detriment to the lender if the interest rates have gone up. So today, the lender adds a clause which makes it compulsory for the borrowers to sign the renewal papers and send them back. Otherwise, they will be responsible for a greater amount. For example, A prime rate plus a large interest rate, etc. For example, prime plus 5 or prime plus 6, which would be an exorbitant amount, could be charged. This will be a big incentive for the borrowers to do their paperwork, because if they do not, they may get caught with a higher interest rate. If the term is for 1 year, this clause may say that the term ends on day 364 of the mortgage instead of day 365. This protects the lender, and the new rate of interest will start before the 1 year period has expired. In the case of default of the mortgage, when the borrowers do not sign a renewal, their deficiency suddenly starts to build at a higher percentage rate, and the default amount may grow even more quickly. The personal covenant. Along with all the covenant's promises in the mortgage, there is also a personal covenant made by the borrower. It is a personal promise to repay the debt. In the case where the borrowers neglect to make their payments, the lender can not only foreclose against the property, but can also sue the borrowers on their personal covenant. When borrowers default on their payments, one of the lender's remedies includes an action on this borrower's personal covenant. This judgment can be enforced by the sale of all of the borrower's assets, not just the subject property. The lender can also take possession of the mortgaged properties and collect any rents. In cases where the borrowers have sold the house to someone who assumed the existing mortgage but then stopped making the mortgage payments, the original borrowers can still be sued. A special clause, such as the one on the previous page, can be added to a contract of purchase and sale to protect the original borrowers. The mortgage is then called a non-recourse mortgage. Acceleration clause, another clause or promise in the fine print of virtually every mortgage document, is the acceleration clause. This clause states that in the case of default, all of the amounts owing become due and payable immediately at the option of the lender. In British Columbia, the courts have the power to grant relief for either the borrower or the lender, depending on the case and the individual circumstances. Mortgage insurance. Insured versus uninsured mortgages. In Canada, when applying for a conventional mortgage, the lender typically will require approximately, or at least historically, a 20% down payment. Because over the last 2 decades, home prices have increased dramatically, many borrowers find it difficult to raise such a high down payment. Mortgage insurance is therefore available to Canadians in order to allow what is called high-ratio financing. Mortgage insurers such as CMHC will finance approximately 95% of the purchase price of a home, allowing buyers to proceed with a purchase, and at the same time protecting lenders whose risk clearly increases with high-ratio lending. The insurer will charge the borrowers for the financing. Usually the charge to the borrowers is a percentage of the loan. Typically, the fee subtracted from the amount the lender will actually advance, which has the effect of increasing the down payment requirement to the borrowers. Historically, the charge was around 2.5% of the loan amount. Mortgage insurance allows the buyers to realize their dream of home ownership by protecting approved lenders against buyers who default. The insurance premiums vary and depend on whether the mortgage loan is advanced all at once or in installments, for example, a building loan. The lender picks up the processing option and the applicable premium is charged. For insurance purposes, there are conventional mortgages and high-ratio mortgages. For conventional mortgages which are uninsured, financing is generally restricted to a maximum of 75 to 80% of the loan-to-value. Loan-to-value means the percentage of loan to the appraised value of the property or the purchase price, whichever is less. In cases where the mortgage will exceed 75% of the loan-to-value high ratio, the mortgage has to be insured, although the bank will also consider risk assessment when lending insured mortgages. Lenders have underwriters who look at underwriting policies and statistical information to determine risk assessment. In addition to looking at the risk level of the buyers, they also look to the market conditions and the property to be mortgaged. Mortgage insurance is available for residential properties of up to 4 units as long as the owner occupies 1 unit. This includes single-family houses, manufactured homes, condominium units, houses on leasehold land, and housing on reserves. This enables buyers to purchase a home with as little as 5% down. The minimum 5% down must come from the borrower's own resources, and the lender must verify that the borrower can cover. Buyers should be aware of legal fees, appraisal fees, and property transfer tax, PTT, etc., which is always changing. Amortization is usually restricted to a maximum of 35 years. Isn't it 25 years now? The maximum loan-to-value ratio is 1 unit, 95%, 2 units, duplex, 92.5%, 3 or 4 units, 90%. There are several types of properties which may be turned down for conventional and or high-ratio mortgage purposes. These are seasonally occupied properties, cottages, ski chalets, rooming or boarding houses, houses of inferior construction, structural problems, foundation trusses, decaying floor joists, lacking central heating system, properties in an area that is being rezoned and redeveloped, where the value is entirely or predominantly attributable to the land alone, houses containing urea formaldehyde foam insulation, UFFI, most property located in an area that is zoned commercial or industrial, property in a deteriorating location or neighborhood, a residential unit within 200 feet of an overhead, elevated roadway or close to overhead high-tension wires, property which is serviced by a polluted well or trucked in water or from water source which is illegal and not guaranteed with an appropriate party agreement, property which backs onto industrial building, auto repair shop, gas station, condominium units in a building in which the condominium corporation does not have an adequate reserve fund or has pending lawsuits. This will create marketability problems for the units. Property which does not have a central heating system or adequate electrical service less than 60 amps. Property in remote areas where there is no determinable real estate market, and property in environmentally sensitive areas. Lenders. A lender is legally known as the mortgagee, and the borrower is legally known as the mortgagor. There are many alternative sources for home loans, just as there are different types of financial institutions from which borrowers may seek funds. Some of these are financial intermediaries whose job is to invest funds they have borrowed from individual and corporate savings. There are conventional lenders such as banks, life insurance companies, trust and mortgage companies, and credit unions. There are also private lenders. Sellers are an example of private lenders, and they can also provide mortgage loans or an agreement for sale. Mortgage insurance is only available to approved lenders. Therefore, in order to be eligible for insurance, a mortgage must be arranged by an approved lender, i.e., a bank, insurance or trust company, or a credit union. Often, private funds are offered for second mortgages and generate a higher return, but these are not insurable. An agreement for sale is an example of private lending. It does not give the buyers legal title to the property. It is really a right to obtain legal title at a later date when all monies owing have been paid in full. Cancellation of agreement for sale. Because the agreement for sale is a legal contract for the sellers to sell their interest to the buyers only, and the buyers are not the actual legal owners of the property, there is no equity of redemption. There is no legal title to redeem, so there is not the usual foreclosure procedure as there would be with a legal mortgage in place. In the case of default, the sellers will ask for a cancellation of the agreement for sale and forfeiture of all monies paid. In the case of default, the courts treat agreements for sale more like mortgages. The courts will issue an interim order, possibly an order nisi, which will set a time in which the buyers must pay all arrears and costs incurred by the sellers. If they fail to pay, the buyers may forfeit everything they have paid and lose the property too. The remedies for both mortgage default and agreement for sale default are similar, and the foreclosure is made by an application for cancellation of the contract. If the property is sold by court order, this is called an action. Usually the contractor will specify the right to possession and sale upon default as in a mortgage contract. The sellers will ask for cancellation of the agreement for sale and forfeit all the monies paid under it. And that's the end of section 1.